Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we are going to look at the GMC stock options, the real winners or the market makers. Yes, I know some of you made thousands of dollars and you proudly put that on the social media, but I tell you what, 80% of the people who lost the money are not going to put their losses on the social media every time they lose money. We are going to analyze this and see why most of the time people lose money and why the money market makers are the real winners. This is no different from Las Vegas casino. The house always wins. It has an advantage, and I'm going to explain what that advantage the money makers or the market makers have. Let's look at the stock price movement today. This is March 12, 2021. The stock opened at $274. It went all the way up to $295. That's when the money market managers or the market makers covered all their puts so that the prices would be the lowest. And when the stock market came down and settled at 264, which is basically just change of $4.50, this is when they covered their calls, or maybe they could have covered the calls in the previous day. How does this correlate with the options? To do that, let us look at the options chart. So this is the option chart for GME. I just took the strike prices from $200 to $300 to show you some basic understanding of how options function in a volatile market. Okay, now this is March 19th expiration date. I'll come back to this March 19th because I have to show you something important. Let me turn on March 12th. So this is March 12th. That is, it expired at 4 p.m. today. As I said, the stock market yesterday was like $264, and this is where it opened at $274, $10 up, and it went up to $295. If you didn't sell your option and you're going to hold it thinking something was going to get better, what happened is the price came down to $265, but in the process, even though the stock market price changed only $4.50, your option actually lost $8.25. And the same story goes here. All these options which are out of money expired basically with nothing left. Let's get down to a little more fundamentals here, like 265. This is the bid price. This is the ask price. There's a huge spread between the bid and the ask. Let's take a look at this one here, 2285. That is, for one option, it is $2,285. That is what they will buy for, the market makers. If they want to sell you that option, it is $2,500. So the difference of $215 is the money market makers' profit. As soon as one investor A and turn around and sell it to investor B, they made $185. You get it? That's not the only story. The second story I want to walk you through that is we have the last price, which was 25 cents. Today's high was $35. When the market opened, this $265 option was $35. That is the time premium you paid for this option for 1 day. Let me see if I can make you understand a little better. The stock price 265, which is the market close, which is 264.50. But anyway, from the previous day, it went up $4.50. But on the other hand, you would think since the market went up $4.50, your option price should also go up. But in reality, the option price actually the highest was $35. And that's because the stock went up to $295. And if you had sold the stock, you would have made some profit. But if you said, no, I'm going to keep it, I'm going to turn in when I get more profit, and then bingo, here's what happened. The last price was 50 cents. $35 loss if you didn't sell it at the time when the stock price was $295. So that explains how quickly the value of an option can swing one extreme to the other, and in more than 80% of the time, it swings in the favor of the market makers. The second point I would like to make is I'll have to bring you to this next week chart to explain what I mean by an important point. Okay, this is the one which is going to expire on March 19th. So bear with me because this is very complicated, and if you don't understand this, that we're going to lose a lot of money. Okay, we talked about the strike price, we talked about the bid and ask, we talked about the last daily high, daily low, and here are the number of open interests. As you can see, the volume is very thin compared to S&P or NASDAQ, which trade like 20,000, 50,000, 150,000 options. For example, Apple may be trading like 100,000 options on a particular strike price. But here you got 1,000 people, and there's not much volume, and that is the reason why here you see this option is like, for example, 260 option is $4,805 versus $5,080. There is a spread of $1,000 for this option for the next Friday expiration date. That is not the worst part of the story. And here, let's look at this. Delta is the rate at which the option price goes up. If the strike price goes up by $1, the option price goes up by $0.60. That sounds like a great this one, but you have to look at here. This is the intrinsic value at the 260. The intrinsic value is $4.95. That is, the stock is at 264.50. The strike price is 260. So the difference is $4.50. And here the intrinsic value, the computer calculates it as where is this? 260, $4.95, and the remaining $44.95 is the time value. The time value, that is, you are paying them $4,495 for 7 days to have the right to buy this option at $260 at the market close on next Friday. I mean, you can do anything you want. You can sell it, you can get out of the market, or you can exercise the option, whatever you want to do. But the time premium is almost like 95% of the option price. But that's not the worst story. And this implied volatility, this killer. This week, this morning, the implied volatility was between 400 and 500%. It is just showing how risky these GME stock options are. So the market makers have to extremely add that risk of this stock swinging from anywhere from $25 to $50 in either directions. It is the same volatility whether it is for calls or whether it is for puts. And well, let's come back here. See, same 349, 333%. So let's get back to calls here. March 12th, it is, let's see what else I need to explain to you. So I talk about the delta, which is the rate at which the option price goes up compared to every $1 rise in stock price. Then theta is the rate at which the option price decays, the time option price decays. Okay, keeping these things in mind, now let's get back to here. This week, the options that expired. As you can see, the only options that went up are the options from 200 to 145, and still they went up by like $5, $8, 4 cents, $6 and all. Whereas from 240 to 265, all these options, even though the stock price went up, the option prices lost money. And this is all the intrinsic, this is all the time value money they lost. For example, 265, $13 were lost, and most of that was the time premium. That is, you paid them like $1,384 for owning that stock for 6.5 hours on a Friday before the stock expired. So I need you to keep that in mind, because the time value is a big killer. Same thing, see, here is the volatility is like 417, 620, because when the prices go this far, like this is $30 from the market close, they have to add all these into account for the extreme changes in the prices. So this is next week's Friday stock. So let's look at that one. Here is 260. I talked about $1,000 difference in the option bid and ask prices. All right, there are only 1,000 options. So the volume is very, very small compared. But remember, if you buy and sell the options, that is 2 trades. 5 options, that is 10 options trade. All of that is included in this one. And the worst part I told you was the time decay money. That is $4,495. And if you bought it for $4,805, your option time value is $4,495. The moment you buy that option, you're already in the red, because this is the money that is left in your option, because there's no intrinsic value. Essence of this is to understand that, one, there's an extremely high volatility. Let me compare that to NASDAQ QQ triple Qs and options. And here is the volatility, which is like 18. This is March 12th, 18, 67%, average 23 to 33%. That means the GME volatility is 10 times more than the NASDAQ triple Q, which itself is a highly volatile ETF. You have to keep track of volatility, the difference between the ask and bid prices. Number 3, the time premium. All these things are working against you. Every minute you're losing money. Doesn't matter which way the stock goes, that is the time decay. Every time you buy and sell, you're losing money, because there's a big difference between what they will buy for versus what they will sell. So if you want to sell an option right now, and this is what they will give you, $3, let's come back here, like 260. If you want to sell your option, this is what they will buy for, $48. But if you were to go back and say, no, I want to get back into the market, then you have to pay $50.80. $50.80. So there are 3 things working against you. Keep that in mind when you get into an option, because it is a money burning position from the moment you buy the option. Thank you so much for your time. Appreciate, and please do subscribe to our channel. We'll see you next time.